I think as long as you have confirmation in the bond market, you can believe in it. But when that link breaks, the value stocks probably crash again. We witnessed an episode like this that happened from the middle of May through the middle of June. It was almost a full 4 weeks. It was violent to the upside. Value stocks, cyclicals, the quote reopened names, small cap value did incredibly well. The growth stocks took a pause. The high flyers corrected. But when that ended, it didn't end gently. You had crashes in the reopened stocks. You had crashes in the value stocks, both absolute and relative to growth. Why would I think that that's not going to happen again? It happens continuously. Well, if you tell me that that's happening against the context of continuously rising rates and a steepening yield curve, okay, I'd buy that. It's a real recovery. But if that link breaks, and I know yields have gone up a bit, both here and abroad, as long as that continues happening, I'm fine with it. But I think you have to watch that more than commentary, more than valuation, more than anything else. J.P. Morgan had a great note about this Sunday, Judge, just talking about the last time we saw a sustained rally in value and an outperformance in value took place from 2016 to 2017. And think about what was going on then. Rates were rising. That's first of all. We were actually raising rates. The Fed was raising rates. And you had true globally synchronized economic growth. And that is the right fertile environment to bet on cyclicals and value. So I hope it happens. I hope that's the environment that we're shifting into. But watch bond yields as your tell.
Yeah. So, Steph, if this is a Josh saying, I'll believe it when I see it, right? He's right. Last time it didn't end well. Is this time different?
Well, I think the liquidity is working. It's been in place for a while, and I think it's starting to hit the system. There's an enormous amount in the system, and we're going to get more in terms of fiscal policy in the next couple of weeks. And as a result, you're starting to see the economic indicators rebound. So you're seeing housing recover. You're seeing autos recover. You're seeing retail sales, e-commerce growth recover and accelerate, by the way. PMIs over 50. That's expansion. ISM, new orders, best since November of 2018. So it's not just the U.S., by the way. It also is the Eurozone. If you look at retail sales, Spain and Italy had double-digit growth last week. You had factory orders in Germany up 27%.
All right, so you think it's legit? You think it's legit?
Well, I think, but I'm trying to give you some. I'm trying to give you some stats.
But you're going through a long list of you're going through a long list of reasons that sounds like you believe in it.
Well, I do believe in it, but I've been talking about it since March. As soon as the Fed said unlimited QE, that's when I went barbell. That's when I went quality on technology and some growth. And I also went into the cyclicals when some of these stocks were down 40, 50, 60%. And I'm sure glad I did. But I think that it's the cyclicals that have more operating leverage from here, and they're under-owned, and I think you're going to see a chase continue. So, yeah, I do believe.
All right. I mean, look, Tom Lee was on with us last week. He told everybody to be prepared for this. He said a monstrous rally. That's the word he used. A monstrous rally was coming. And here's what he said about why now was the time.
When you look at the cyclical stocks, these are the names that have been written off by the market. You know, it's only 26% of the market cap. They're trading at around 15 times forward, which is the same as an emerging market stock. And we're talking about blue chip U.S. names. And so I think that there is going to be a need for people to have exposure. And if they think the trend in cases is falling and the economy is opening safely, and look at the jobs number today. We retraced 50% of the job losses. I think if the economy is healthy, these cyclical stocks could rally big. And it was over 30% in about 2 weeks. It was a massive rally.
Meghan, Tom Lee is looking prescient again. Is he going to be right, and for the right reasons?
I have to agree with Josh on this one. I think as you look at value, for value to work on a sustainable basis, we need to have certain conditions come into place. Higher yields, better than expected economic growth, and robust economic growth. So I think you have to ask yourself, do you believe that you can extrapolate the pace of economic recovery that we've seen to date? We are a little bit more cautious on that. We don't think we're going to have this same linear trend, and we're already seeing signs of plateauing. I respect Stephanie pointing out the ISM and the PMI numbers, but those numbers were very, very bad. So having a 58 or a 54, depending on which one you're looking at, above 50 is good, but we need to see sustained numbers above 50 for a period of time to recover the growth that we've lost. So we're not overly bearish. I think that at the end of the day, yields are low, bonds are unattractive, stocks are where you have to be. You have to be invested. But we're slightly cautious on this economic recovery continuing at this pace. And so for us, it's about diversification, have a little bit of that value exposure, but don't go all in on that because we think growth is still going to be delivering good returns for investors over the next 12 months.